Active fund managers want to earn better returns than the market while taking less risk. I've talked about the shift toward index funds in Canada and the US and how the prolonged poor performance of active funds is a driving force of that shift. Well, it seems logical that fund managers, some of the smartest, highest paid, and best equipped people on the planet, should be able to use their resources to create a favorable result for investors. The data simply does not support their ability to do so. On average, active fund managers consistently underperform the market. If these people are so smart, why is it not showing up in returns? I'm Ben Felix, Associate Portfolio Manager at PWL Capital. In part one of this two-part episode of Common Sense Investing, I'm going to tell you some of the reasons why it's so hard for active managers to beat the market. William Sharpe's 1991 paper, The Arithmetic of Active Management, published in the Financial Analyst Journal, is a great starting point in explaining the challenge that active managers face. It's pretty simple. Actively managed funds, on average, have significantly higher fees than passively managed funds. Quick side note, Canadian mutual funds have some of the highest fund fees in the world, with an average of 2.35%. Contrast that with the fact that you could build a COUCHPOTATO ETF portfolio for as low as 0.16%. So, back to William Sharpe. His 1991 paper said, before costs, the return on the average actively managed dollar will equal the return on the average passively managed dollar. This makes perfect sense, because there is one global market, and in aggregate, all passive and all active funds are investing in that same market. Sharpe went on to say that after costs, the return on the average actively managed dollar will be less than the return on the average passively managed dollar. Same returns before fees, lower returns after fees, due to active management's higher fees. If fees were not in the picture, you might expect about half of active managers to be able to beat the market. Add in fees, and that number drops to less than half at best. Okay, so the average active manager is unlikely to beat the market in a given year due to fees. But who's going to hire an average active manager? The idea of manager skill has been the subject of a lot of research. In a 1997 paper published in the Journal of Finance, Mark Carhart explained that investment expenses and exposure to certain risks almost completely explain the persistence in equity mutual fund returns. So, if there's little to no evidence of manager skill, it means that the managers who have done well may have just been lucky in the past. Finding the manager who has done well in the past and will continue to do well in the future is a gamble, not a guarantee. Are they skilled, or are you just giving your money to someone who's been lucky? An important distinction to make here is that when we're talking about skill, we only care about relative skill. Any mutual fund manager is likely to be intelligent, well-read, and competent, but they need to be more intelligent, more well-read, and more competent than the other managers on the other side of the trades that they're making. Anytime a manager sells a stock that they think will do poorly, another manager is buying that same stock because they think that it will do well. Only one of them is going to be right. The investment management industry is full of PhDs, CFA charter holders, and MBAs. Currently, most of the world's stocks are owned by large institutions rather than individuals. Most trades are a bet between two highly skilled professionals. The level of competition is exceptional. As more and more skilled managers enter the active management business, luck becomes increasingly important as a determinant of their success. Supporting this idea, in a 2013 paper, Pastor, Stambaugh, and Taylor found that the increasing size of the actively managed fund industry has a negative impact on active funds' performance. More skilled competition is making it increasingly challenging to generate higher returns. Let's say that you do find a skilled manager. They've had a few good years, but you can tell that they're skilled rather than lucky. So you invest your money in their fund, and so do a lot of other people because the performance has been pretty good. Fairly quickly, the fund will grow to a point where the manager's skill becomes less useful or even useless because there's so much money that needs to be invested. It's one thing for a skilled manager to find a few good stocks to invest a few $1 million in. But if a fund has a few $1 billion to invest, the manager may have trouble being different from the market. When that happens, the investors in that fund end up with a really expensive index fund, also known as a closet index fund. The math just doesn't work out for the average active manager, and finding a manager that will be consistently above average is extremely difficult in today's increasingly competitive environment. Even if a manager is successful in generating higher returns, their success will probably be their own downfall. In my next video, I'll be talking about one more reason that causes many actively managed funds to underperform. My name is Ben Felix of PWL Capital, and this is Common Sense Investing. I'll be talking about this and many other common sense investing topics in this series, so subscribe, click the bell for updates, and I'd also love to hear from you as to what topics you'd like me to cover.